bloodbath out there. So much so, I had to wear my good old red Prada loafers today. The hashtag for this video is going to be SDT, and you all know exactly what that means. I'm going to explain all this to you in 3 simple, fast steps. Step number 1, it starts with not only the cerveza sickness, but now the oil price. This is a chart going back to 1970, 2020, price of oil, 20 bucks up to 140. This is adjusted for inflation. You can see one thing that always stays consistent with the oil market, and that is massive volatility. Taking it all the way to today, where I saw some reports the price of oil in the futures market got sub $30. That drop is the second biggest in history. Editor, throw up that chart. You may be asking yourself, how on earth did we get here? It all starts last week. OPEC meets with Russia. The price of oil was plummeting as a result of the cerveza sickness. They came together to potentially agree to reduce production to artificially bump that price. Russia was not playing ball. One of the reasons they're a country where a good percentage of their GDP is a result of oil production. They said, we can't afford to reduce the amount of production because we need these dollars coming into the country. They get pissed, more specifically Saudi Arabia. They say, fine, you want to walk out of the meeting, we'll increase production, we'll flood the market with oil, that'll drop the price, we'll still be okay because we can produce oil at a lot lower cost. They basically give Russia the middle finger. That is what pushed the price of oil off a cliff over the weekend. This creates chaos in the markets. This morning, when I checked, Dow was down 7%. I read some reports saying almost 2,000 points in the red. That is insanity. Trading was halted. This triggered a circuit breaker in the New York Stock Exchange. That is not good. But I want to point out one more thing before we move on to step number 2. That is the price of oil right now hovering around $30 a barrel, but the cost of producing oil in the United States, especially with the shale producers, is extremely high, $73 a barrel. This makes insolvent Sam, who could be your uncle, very, very unhappy when it comes to the credit markets. More on that later. Step number 2, the credit markets. It all starts with the U.S. corporate bond market, broken down into 2 separate categories. Above this line, investment grade. Below that line, junk debt or high yield. It's crucial you understand the difference between these two. The pension funds can really only put their money into investment grade debt. The big banks and other financial institutions like JP Morgan could go into the junk bond market and try to eke out that slightly higher yield. Both of these institutions have been pushed way out the risk curve because the Fed came in, dropped interest rates to 0 for over 10 years with ZIRP, 0% interest rate policy. Very important that I also point out that right on the border is $4 trillion of triple B rated investment grade debt. But if that were to get downgraded into junk, it goes into a market where there's only $1 trillion currently. That's a really big deal. More on that later. This gentleman, who looks like your friend and family member Fred, is the ratings guy. The big difference between him and your friend and family member Fred is that he is always drunk. Right here with his bottle of whiskey, a big M on his hat. We will say that stands for, how about Moody's? Moody comes in and rates all of this debt, whether it's AAA, triple B, or junk debt. He has a lot of power because if he downgrades a lot of this triple B debt, that can mean big, big problems. Also, this is the intent of the central banks. It seems like it's madness that we're creating all of these unintended consequences, when if you listen to the central banks themselves, it was actually what they wanted to pull off. And if you don't believe me, check out this video from the Bank of England.
The Bank of England's Monetary Policy Committee has been purchasing assets financed by new money that the bank creates electronically. This policy is designed to inject money directly into the economy. The aim is to boost spending to keep inflation on track to meet the 2% target. The bank purchases assets from private sector businesses, including insurance companies, pension funds, high street banks and non-financial firms. When the bank buys assets, this increases their price and so reduces their yield. That means the return on those assets falls. This encourages the sellers of assets to use the money they receive from the bank to switch into other financial assets, like company shares and bonds. As purchases of these other assets start to increase, their prices rise, which pushes down on yields generally.
And to take it back to oil, because those central banks forced all this money to go into riskier assets, most of that money went into oil corporations and to shale corporations. Over 11% of BBB rated debt is in oil. That's over $400 billion. Moving over to another credit market. This is the USD debt market outside of the United States. Countries and corporations in 2012 load up on dollar-denominated debt because the DXY drops all the way right around 75. To give you some context, it's at 95 today, and that's dropped all the way down from about 100 a month ago. Plus, 0% interest rate policy took those rates down so low that this debt was very cheap for them to attain. This was a huge benefit for them at the time, but they took a big gamble. A lot of their revenue comes in the form of another currency. Let's call it the peso. So if this trade goes against them, they're going to have a lot harder time servicing that debt. There were some countries that were big oil producers that said, well, that's not really a big deal because we have all of these dollars coming in because we sell oil. But they forgot that if the price of oil goes from 100 all the way down to, call it 30, they're going to have a really hard time servicing that debt. One more thing I want to point out is Art Berman's tweet referencing what we talked about in step number 1, where Russia pulls out of that OPEC deal. Editor, let's throw up his tweet. And if you're not following Art Berman, you need to do that right now. This guy is the leading expert on oil. But he writes, Putin wants to take down the Western financial and credit system. He wrote his PhD thesis on energy. He knows exactly what he's doing. So maybe Russia is playing chess while the United States is playing Uno. I'm going to put the pieces of the puzzle together for you right now. Step number 3, the oil price crash endgame. Let's connect the dots going right back to the corporate bond market. BBB debt, 4 trillion. Junk, 1 trillion. Above the BBB, you got 2.5 trillion. Editor, throw out that chart. You can see how much the corporate debt has grown since 2008. Absolutely staggering. Remember, the pension funds need that 7% to meet their liabilities. If they're only getting 4 by buying the debt of oil corporation, even though it's BBB, they have to go to the bank. They levered up in order to buy that debt just to get close to that number they need. So if they've got a bond, let's say for $1,000, they might have only paid $500 for that bond. The rest of the money they borrowed from the bank. If Oil Corp's bonds go from BBB down to junk, they get downgraded because the price of oil goes down, the interest rate on that debt, for the sake of this example, let's say goes from 4% to 8%. Remember, there's an inverse relationship between the interest rate and the value of that bond. So if it goes from 4% to 8%, most likely the value of the bond goes from 1,000 down to 500. But they levered up. They took 50% leverage. So their equity goes to 0, even though the value of the bond is still $500. But this is just the tip of the iceberg. It gets a lot worse when we come over to the train wreck that I'm calling the Doom Vortex Infinity. And yes, if you are wondering, now is officially stiff drink time. So sit down, pour yourself that glass of whiskey, because you're going to need it. The oil prices are crashing. While that's happening, the cerveza sickness is wreaking havoc. The everything bubble is turning into the everything crash. Stock market is plummeting, down 1,800 points the last time I checked just today. This has a huge effect on the corporate bond market. Why? Going back to 2010, all the corporations loaded up on debt to buy their own shares back. So Moody, the drunk ratings guy, sees the value of their assets going down and downgrades them from BBB into junk status. So even though the oil corporations are only 11% of the total pie, we could see a scenario, in fact, it's very likely that we see a scenario where the majority of this BBB debt gets downgraded into junk. Interest rates increase dramatically because you have an additional $4 trillion of supply hitting the same limited pool of capital. Let's be gentle for a moment and assume interest rates only double, going from 8% to 16%. How do these corporations service their debt? And I'm not just talking about oil, but blue chips like AT&T and Ford that have loaded up on debt over the last few years to buy back their own shares. If interest rates go through the roof, there's no way they're going to be able to service that debt. And let's not forget, we're most likely going into a recession/depression. And in a recession, the revenue of these corporations goes down, down, down. So they have less cash coming in, while at the same time, the amount of debt or their debt payments are going to infinity and beyond. And I haven't even talked about all those corporations that are already in junk status, like Tesla, Uber, Beyond Meat. And I don't know if Beyond Meat is, but if they're not there now, they definitely will be in the future. But all these corporations are burning cash like your college buddies with a fistful of hundreds at the local gentleman's club. So there's no way they're going to be able to go back into the market and take that money at 16%. They can't afford it. They all go bust. That is the bottom line. Going back to the pension funds, even if they were able to survive this debacle, they go back into the market, and now there's a much larger pool of cash for a limited supply of investment grade debt. That has the opposite effect. Instead of increasing interest rate, that dramatically lowers them. So if they couldn't get a 7% yield at 4%, there's no way they're going to be able to get it at 0 or 0.5%. Then they go to the taxpayer. The states say, listen, our pension funds are completely bust. They increase property taxes or do anything they can to get that last dime out of your back pocket. But they're increasing these taxes as we go into a recession. What happens to tax revenue in a recession/depression? It falls off a cliff. There's no way that these pension funds will be able to survive. And the baby boomers are all retiring. Who has been the main driver of the stock market other than the corporations over the past 25 years? Baby boomers putting all that money into their 401k. If we go through a crash, there's no way that they're going to buy that dip. They can't afford to. So you're left with a situation where there's no buyers in the junk bond market, and there's potentially no buyers in the stock market. And all of this feeds on itself. And it starts with oil prices crashing, the cerveza sickness, and this everything bubble that the Fed has created coming crashing down. That's why I call it the Doom Vortex Infinity. And it goes back to step number one, where you have to ask yourself, did Putin just throw a hissy fit, or is he playing a three-dimensional game of chess with the United States economy and the dollar? Oh, but wait, there is more. remember there's another credit market we discussed in step number 2. Country Tweedledee and Corporation Tweedledum load up on USD debt in 2012. They still have the debt, but oil goes from 100 to 30, puts them in a bad spot. 2 options Country Tweedledee has. 1, they can go into the FX market, print their own money, buy the dollars they need. This devalues their currency, creates domestic inflation, crushing Corporation Tweedledum because their revenue is in the form of that devalued currency, but they still have the dollar-denominated debt. The other option for Country Tweedledee is to pump more barrels of oil out of the ground. If they have $1,000 in debt before, they needed 10 barrels of oil to service the debt. Now they'd have to pump over 30 barrels of oil to get the same amount of dollars. This creates greater supply of oil in the open market. It's just supply and demand. If there's more supply, the price of oil goes down, which makes the doom vortex of infinity much, much worse. And I saw on Twitter this morning, one of the talking heads at CNBC said nobody saw what was happening in the repo market, but you know as well as I do, that's not true. We've been discussing the repo market on this channel, the cerveza sickness, and the corporate bond market for months. So if any of your friends and family member Freds still aren't up to date on what we talk about, make sure you share the channel with them, share Macro Voices, share the Real Vision videos so we can all be much better prepared for the future. For more content that'll help you build wealth and thrive in a world of out-of-control central banks and big governments, check out this playlist right here, and I will see you on the next video.